Good morning. Welcome to Stock Market Today. It's Monday, March 23rd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com /today. Sign up for a free email where you can get a lot of the content that we use in this show, as well as check out daily stock ideas to consider that hit your inbox every trading day before the market opens. So U.S. equities finished sharply lower on Friday, with weakness intensifying into the close. Energy was actually the only sector to finish higher on the day, while utilities closed down by more than 8%. Treasuries were stronger with the curve flattening. The dollar was stronger on the yen and euro. Gold finished up 40 basis points, and WTI crude closed down 12.7%, reversing earlier gains after a nearly 25% bounce on Thursday. And as we get to the desk this morning, it's been a bit of a wild ride overnight in the futures. They're down 3%. But off their worst levels. They actually traded limit down shortly after overnight trading began last night. Asian markets mostly weaker overnight, with Taiwan and South Korea among the worst performers. Japan did buck the trend, though, and did gain over 2%. European markets are under pressure. Treasuries are rallying across the curve. The dollar is weaker against the yen, but stronger against the euro and sterling. Gold is up 90 basis points, and WTI crude is off another 70 basis points to get us going on a Monday morning. As we take a look at the structure of the S&P 500, we've been highlighting, we and everybody else have been highlighting the 2018 lows. Well, those are starting to give way here in the overnight session, currently trading below that 2330 level. That's been so important for a lot of people. Should that continue to give way, we have to start thinking about 2,000 to 2,100 on the downside. That's the consolidation and breakout in the 2015, 2016 timeframe. Resistance, I mean, right now we're calling it 2,700, but that level is obviously going to continue to move lower should the market continue to move lower, as it looks for a near-term bottom. We're just not seeing it yet. The selling pressure has been relentless, and we're looking for signs of a near-term bottom, but we're not there yet. The RSI is holding bearish ranges, not oversold, but still in bearish ranges, and Chaikin money flow. We'll continue to call it neutral with a bearish bias. So like I said, we continue to look for a near-term low here in the market from which a bear market rally could potentially begin. We're just not seeing signs of it yet. We're not inclined to stick our hand out and try to catch the falling knife. We'll look for evidence that selling pressure is abating, and then kind of reevaluate what a potential upside move could look like. Turning now to our market in a minute. What are we writing about today in the note to Chaikin Analytics clients? Well, relentless selling pressure continues, and it has been relentless. There's been virtually no reprieve since early March. As we said, 210 is the next key level for the SPY. That roughly lines up with 2,100, 2,000 to 2,100 for the index. Treasuries and the dollar remain the only true safe havens in this environment. Gold pulls back as investors continue to raise cash, right? In a precipitous sell-off, in a situation where liquidity becomes a concern, correlations tend to go towards one as investors look to sell whatever they can to raise cash. And then futures did trade limit down overnight, but have since rebounded. They're down about 3%. But again, quickly, right after the open at about 6 p.m. last night, they did trade limit down. Turning now to the major indices from a power market perspective, and there's really nothing good to say here. I'm not going to sugarcoat it. There's nothing good to say. The Dow is down 4.3%, 0 bulls to 5 bears. S&P 500 down 4%. Only one bullish stock. That one bullish stock, for those of you who are interested, is Regeneron. One bullish stock, 136 bearish stocks. The NASDAQ, again, one bullish stock. It is Regeneron, down 3.86%. So a slight outperformer. I mean, we've got to look for some positives where we can find them. One bull to 21 bears there. Small caps, actually second day in a row of significant outperformance. Still down on the day, but significantly outperformed the S&P 500. 35 to 507 bulls to bears there. Bonds, after a sell-off mid to late last week, see a reprieve, up 7.5% to send yields lower once again. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain strongly bearish. major indexes across the board are strongly bearish. Our stock of the day now, the auto-generated stock of the day was not one that we could use, so I'm going to use the stock that I'm featuring in my note to Chaikin Analytics clients. And this is kind of what we're looking for, is opportunities to potentially take advantage of further weakness when very bearish and bearish stocks bounce. Pro Assurance Corporation has a very bearish Chaikin Power Gauge rating due to very weak earnings performance, poor financial metrics, negative expert activity. It does have some strong near-term technicals as the stock has rebounded from $18 to $28. So a very bearish stock, weak trend, weak industry group. All the industry groups are weak. Below a declining long-term trend line. Stock's been an underperformer since the late October, early November timeframe. Chaikin money flow mixed with definite bearish bias. Stock is overbought here in the near term. We don't see a lot of stocks overbought, but this one is. So when we see a very bearish stock that's underperforming the market and it's overbought, we want to maybe take advantage of some potential opportunities to trade to the bearish side of the coin, with the caveat being, options premiums are rich given the volatility in the market. We like looking at potential put spreads. PRA is a name where we could potentially take advantage of that. Again, we want to do that in a risk-defined way, because if we do get a bear market rally, it could be sharp and it could be fierce. I don't think it makes sense to just kind of be out there naked short. I think you want to look at put spreads and really define your risk to take advantage of further moves to the downside in some of these bearish and very bearish names that have rebounded here in the near term. Taking a look at our sector tracker now, Friday was a nice reprieve. We actually saw some green on this metric, but that proved to be short-lived with the sell-off in the market yesterday. Over the past 5 days, all of the major sectors are lower. Staples are the best performing group. Imagine being down 11% and being the best performing group. Materials, whatever. They've been an absolute disaster. They're down 12.5%. So sure, some relative strength over the past week, but nothing really there to get excited about. Healthcare and comms round out the top 4. Discretionary tech, UTs, and financials are middle of the road. The industrials are obviously very cyclical. Energy continues to be an area of the market that we want to avoid. It continues to underperform. It continues to be bearish. In addition to a global growth slowdown stemming from a pandemic, we also have an oil price war that's not likely to help the energy group anytime soon. And then real estate just goes to show you how important it is to do your work and drill down beyond the sector level, because you would think real estate would be holding up better, but you have a lot of areas of real estate that are massively exposed to a global slowdown, namely commercial real estate. You also have the senior living facilities, which are exposed to the COVID-19 pandemic. So a lot of moving parts in the real estate group. It is the worst performer over the past 5 days of trading. Our industry in focus now, semiconductor services, and it's still an outperformer over the past 6 months, but the intensity of that outperformance has certainly diminished. Power bar ratio is very weak, 0 bulls. A lot of that from the work that we've seen, 13 bears. Number 11 of 21 subsectors having moved up 4 slots over the past week. If we're looking for opportunities on the bearish side, when stocks become overbought, you want to look at names like Ambarella, Impinj, and Xilinx, all with very bearish Chaikin Power Gauge ratings. Taking a look at the chart now, you can see right after being a strong outperformer for most of last year, it has now begun to underperform. And when semis are underperforming, that is not a good sign for the overall market, and that has certainly played out once again. Below a declining long-term trend line, weak trend, right? 0 bulls, 13 bears. Does have a neutral plus Chaikin Power Gauge ETF rating, but hard to get excited. Underperforming, bearish money flow. It is oversold, as most are oversold, but semis are underperforming. That's not a good sign. Taking a look at what's trending now. Yesterday's S&P 500, or Friday's S&P 500 gainers and losers. Carnival Cruise Lines provided a bookings update, and it's amazing to me that folks are still booking cruises, but I guess investors like what they heard. Their stock was up 20% on Friday. MGM announced that their CEO is stepping down. That was over the weekend. Stock was up 18%, a little bit of a reprieve in these travel and leisure stocks on Friday. MOS released some balance sheet comments that seem to soothe investor concerns, at least in the near term. Stock up 16.5%. Obviously, a COVID play is United Airlines. The airlines are, looking for a bailout, and that stock was higher by 15% on Friday. MPC named a new CEO earlier in the week. That news looks like it came out on the 18th. Stock was higher on Friday by about 13.3%. So a lot of volatility at the individual stock level in both directions. I mean, just look at the size of the moves that we're seeing on both sides of the coin. On the loser side, Fleer is a very bearish stock. It was down 18%. I didn't see anything company specific, but this is a very capital intensive name, and it's cyclical. So that stock was under a lot of pressure. WEC, nothing really company specific there, down 18%. Arconic caught a downgrade at Barclays. That stock down 16%. Didn't see any real news on Lowe's to send that stock lower by 16%. And ResMed, kind of surprising here, worst performer in the healthcare space, down 16%. They do make respirators. Didn't see any company-specific news there. Stock had been holding up, so maybe a bit of profit taking there into the weekend. Stock down 15.99% on the day. Taking a look at what we're talking about now. Long-term treasuries hold support. We're looking at the TLT here, the iShares 20-plus year Treasury bond ETF, right? We've looked at this one. It went parabolic. We called this potentially a blow off top a couple of weeks ago, and the fund has subsequently slid all the way back down to the 200-day moving average, where it found support and has now rebounded back above the 50-day moving average, and treasuries are continuing to move higher this morning. What's interesting is on the move lower, RSI remained in bullish ranges and is now starting to work higher. And on a relative basis, the treasuries are outperforming equities. That shouldn't come as a surprise. Even with treasuries giving back some strength here in the near term, they continue to outperform, right? Rotation playing out of equities, potentially into treasuries. The outperformance, it's fierce. I mean, I could draw the line here. I really don't have to. We're at relative highs on a 2-year basis for long-term treasuries relative to the S&P 500. Wouldn't be surprised if that was likely to continue to be the case, just given volatility. But just bear in mind that treasury volatility is also extremely elevated, and I would expect that to continue in and around announcements on a potential fiscal stimulus package. I mean, what does that do for government treasuries? So expect volatility across asset classes to continue to play out. Gold, GLD is dancing with the 200-day moving average now, and it's interesting to me that even the safe havens have come under pressure, right? GLD, after topping out near 160, has pulled back to the 140 level, where it's now doing the dance with a rising 200-day moving average. Unlike treasuries, however, the RSI of GLD has fallen into bearish ranges, right? So that, not holding up from a momentum standpoint the same way we saw with the treasuries here, right? So just something to bear in mind. On a relative basis, gold remains compelling, also at a 2-year high relative to the S&P 500. So a little bit of safe haven buying. I mean, I know what the thesis is on gold. If we're going to print money, and who knows how much money we're going to print to save the economy, the thesis is that it's going to at some point ramp inflation, and you are going to want exposure to gold. Bear in mind that GLD is, for all intents and purposes, a paper asset. And while it has sold off here, my understanding, based on conversations that I've had and reading that I'm doing, is that the physical gold market is actually trading at a premium to the spot price of gold. So as always, know what you own. Be aware of it now more than ever. If you're looking at some of these funds, just be aware of what you own. And then finally, the US dollar remains a safe haven. UUP, we showed it last week, breakout, move topside, a little bit of a pullback here, but continues in an uptrend. What's interesting to me is that recent highs were met with a lower high, so maybe in the RSI, so maybe we see a consolidation here. But strengthening dollar is going to continue, in my opinion, to act as a headwind to already beaten down commodity prices. I'm showing you DBC, the commodity ETF here, and you can see that as the dollar has spiked, commodities have accelerated to the downside. That's going to wrap us up for today. chaikinanalytics.com/test drive for a free 14-day trial. I'll be back with you tomorrow.